Tom Lee from Fundstrat just made a bold call that most investors are not ready to hear. He believes the market is going to move past the Iran crisis and start focusing on opportunity in the second half of the year. That is a major shift in thinking, especially with all the fear and uncertainty in the headlines right now. In this video, I am going to show you the clip of Tom Lee on CNBC, then break down exactly what he means and whether it actually makes sense. And after that, I will walk you through 3 value stocks that could benefit if he is right. Hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Let's hear what Tom Lee has to say.
He is Tom Lee, CIO of Fundstrat, CNBC contributor, and on set, we're going to ask you to graciously, if you would, stick around for a couple of different blocks because we love Tom Lee. Thanks for coming on.
Yeah, glad to be here.
You're not changing that 7,700?
We're not.
Okay, why not?
One, I think 7,700 was a conservative estimate to start because markets have been steadily repricing on a PE basis, and we're only assuming modest PE expansion this year to 7,700. And as much as the war is creating obviously a huge short-term setback and a lot of uncertainty, including effects on monetary policy, ultimately wars are going to be good for the U.S. economy and the U.S. stock market. So I think as we get towards the end of the year, the market stops thinking less about the crisis element of this and more on the opportunity.
I know, and that's hard to say, and it's not an endorsement, by the way, of anything. I get what your point is, because you look at history, and there's like the old maxim, I'm going to chunk it, but it's something like you sell on the sound of trumpets and you buy on the sound of cannons, meaning when things seem the worst is often when the market does what you least expect it to do, correct?
Yeah, that's right. I mean, I think right now, if we asked any investor, they can list all the reasons why they're worried and what could go wrong, and that's what gets priced in very quickly. But we have to know that that's counterbalanced with opportunities have always emerged. I mean, when we look at the last 8 major war events, the market was always bottoming very early into the conflict.
I have said, nobody cares what I think, but I have said that just given what I've done for 30 years, the markets feel a little too complacent, a little too sanguine maybe about what you just talked about. Go into that a little bit. Do you feel like people are a little bit too comfortable? It doesn't sound like you are. You sound like this is where we are and everything's fine.
Well, it's a good question. I was thinking about this on the way here, that we've already had a rolling bear market because last year energy was already in a 3-year bear market and financials had been in a downturn. The Mag 7 has been in a downturn, tech and software. That in total is like 70% of the S&P. And we know over the last few months, before even the war started, gold was going parabolic. So in some ways, I think the market was pricing in uncertainty in a geopolitical event. And I think the reason people are maybe, as you're saying, somewhat complacent, I think people have de-risked already.
How do we say they've de-risked when markets are down like 4 or 5% this year, and in a midterm election year, which is this year, by the way, historically, going back 100 or whatever years, the S&P tends to fall about 15% once on average in a midterm election year. We're only down 5. That seems complacent to me.
Yeah, it's a good point. I think we have to look at global stocks. Last year, more money was made owning emerging markets, owning gold over stocks. Emerging markets have corrected a lot more than the S&P has because the world is worried about growth. And as you worry about growth, you want to own the growth index, which is the S&P 500.
Right out of the gate, Tom Lee doubles down on that 7,700 target. No hesitation, no adjustment. He is sticking to a bold prediction that the S&P 500 could hit 7,700 by the end of the year, even with geopolitical tensions rising and uncertainty everywhere. And what makes this interview so interesting is not just the number itself, but the reasoning behind it. In a market environment where most analysts are constantly revising targets based on headlines, the fact that he is holding firm suggests he believes the underlying fundamentals have not changed in a meaningful way, and his first key point is something most retail investors completely overlook. He says that 7,700 was already a conservative estimate. That is important. because when people hear a big upside target like 16%, they assume it is aggressive. But from his perspective, that target is based on only modest expansion in valuations, specifically the price-to-earnings ratio. What that means in plain English is this: he is not even assuming the market gets overly optimistic. He is just assuming that valuations expand slightly as conditions stabilize. And historically, that is exactly what tends to happen when uncertainty starts to fade. Now here is where things start to get controversial. He makes the argument that wars, as uncomfortable as it is to say, tend to be positive for the U.S. economy and the stock market over time. And I want to pause here because this is where a lot of viewers might push back. It sounds cold, it sounds counterintuitive, but what he is referencing is historical market behavior, not making a moral statement. If you look at past conflicts, markets often bottom early and begin recovering long before the situation is resolved. There is an old saying mentioned in the interview that perfectly captures this idea. You sell on the sound of trumpets and buy on the sound of cannons. In other words, when fear is at its peak, that is often when the best opportunities are created. Personally, I think this is one of the hardest concepts for investors to accept, because emotionally it feels wrong to buy when everything looks like it is falling apart. But the market is not driven by emotion, it is driven by expectations, and when expectations get too negative, even slightly better news can push prices higher. Tom Lee reinforces this by pointing out something very important. Most investors today can easily list all the risks: geopolitical tensions, inflation, interest rates, economic slowdown. All of that is already top of mind, and when something becomes that obvious, it usually means it is already priced into the market. That is a key insight, because markets do not wait for clarity, they move ahead of it. Now the interviewer pushes back and raises a really good point. Is the market actually too comfortable right now? Are investors underestimating the risks? And this is where Tom Lee introduces one of the most interesting parts of his argument. He says we have already been in what he calls a rolling bear market. Think about that for a second. Instead of the entire market crashing at once, different sectors have been declining at different times. Energy has been weak for years. Financials have struggled. Even the so-called Magnificent Seven, the biggest tech stocks that have been carrying the market, have experienced downturns, and when you add all of that up, he is essentially saying that a large portion of the market has already gone through its correction. This is something I actually agree with to a certain extent, because if you look beyond the headlines and the index level, many stocks have already been hit hard. The pain has just not been evenly distributed. He also points to gold going parabolic before the conflict even escalated. That is another signal that investors were already preparing for uncertainty. Money was already moving into defensive assets. So when people say the market looks calm, what he is arguing is that beneath the surface, investors have already de-risked. They have already adjusted their portfolios. They are not as exposed as it might appear. Now the interviewer brings up a historical stat that is hard to ignore. In midterm election years, the S&P 500 typically falls around 15% at some point. And so far we are only down about 4 to 5%. That does raise a valid concern. Are we due for a bigger drop? Tom Lee responds by expanding the lens beyond just U.S. stocks. He highlights that last year, investors actually made more money in emerging markets and gold than in U.S. equities, and those areas have already seen significant corrections. So again, his argument is that risk has not disappeared, it has just been redistributed and in many cases already absorbed by the market. Here is my take on that. I think both sides have a point. On one hand, yes, a lot of damage has already been done in certain sectors. But on the other hand, markets can always find new ways to surprise people. Just because some areas have corrected does not mean the entire system is immune to further downside. But this is what makes this interview so valuable. It forces you to think beyond the surface-level narrative. The real takeaway from Tom Lee's perspective is this: markets are forward-looking, they anticipate, they price in fear quickly, and they tend to recover before the actual situation improves. And if he is right, then what we are seeing right now is not complacency, it is positioning. Investors have already adjusted for the worst-case scenarios, which means the bar for positive surprises is actually quite low. And that is where the opportunity lies. Because if the news flow shifts even slightly from negative to less negative, that could be enough to push the market higher, not because everything is perfect, but because expectations were already so low. Now, whether you agree with his 7,700 target or not, I think the bigger lesson here is about how to think during uncertainty. Do you follow the headlines and react emotionally, or do you step back and ask what is already priced in? And that is the difference between reacting to the market and understanding it. Now, let's dive in and talk about the 3 best value stocks to buy now. The first stock is 𝗗𝗚𝗏𝗧 Technology, ticker symbol GCT. Before we even look at numbers, you need to understand why this business matters. 𝗗𝗚𝗏 is not just another e-commerce platform. What they are building is essentially a global infrastructure layer that connects manufacturers directly to retailers and consumers, specifically for large parcel goods. Think furniture, home appliances, and oversized products that are traditionally difficult and expensive to ship. This is a massive pain point in global trade. Shipping large items across borders has always been inefficient, fragmented, and costly. 𝗗𝗚𝗏 is solving that by integrating logistics, warehousing, and marketplace functionality into a single ecosystem. That is where the moat begins to form. Because once you control both the marketplace and the logistics layer, you create a powerful network effect. Suppliers want access to buyers, buyers want access to inventory, and both sides benefit from lower costs and faster delivery. Over time, that becomes very hard to replicate. And here is what I find really compelling about this business. It is not trying to compete with traditional e-commerce players on small goods. It is focusing on a niche that is underserved but incredibly valuable. Large parcel shipping is complex, and complexity creates barriers to entry. Now let's talk about the financial side, because this is where things get even more interesting. 𝗗𝗚𝗏 has been showing strong revenue growth, driven by increasing adoption of its platform. More sellers are joining, more transactions are happening, and the company is scaling its logistics network globally. That kind of growth is not just about demand, it is about execution. But what really stands out is profitability. This is not a company burning cash to grow, it is generating earnings while expanding. That is rare, especially in a technology-driven platform business, and despite that, the valuation remains relatively low compared to its growth profile. This is exactly the kind of disconnect value investors look for, a company that is growing, profitable, and still not fully recognized by the market. From my perspective, this is one of those businesses that could quietly compound over time. It is not flashy. It is not dominating headlines. But it is solving a real problem in a scalable way. The risk, of course, is execution. Expanding a global logistics network is not easy. There are operational challenges, cost pressures, and geopolitical factors that can impact trade flows. But if management continues to execute, the upside potential is significant. And this is where timing becomes important. When a company like this is still under the radar, that is often when the opportunity is greatest. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's move on to the second company, and this one operates in a completely different space, but the value opportunity here is just as compelling. The second stock is BCB Bancorp, ticker symbol BCBP. At first glance, a regional bank might not sound exciting, but sometimes the best opportunities are found in places where most investors are not looking. BCB Bancorp is a community-focused bank that provides a range of financial services including commercial lending, residential mortgages, and deposit products. It operates in markets where relationships matter, where local knowledge matters, and where trust plays a critical role. And that is something large national banks often struggle to replicate. The moat here is not technology, it is relationships and market positioning. Community banks have a unique advantage because they understand their local economies better than anyone else. They can make more informed lending decisions, build stronger customer loyalty, and maintain stable deposit bases. Now, why does this matter in today's environment? Because we are in a period where interest rates and economic uncertainty are reshaping the banking landscape. Larger institutions are dealing with regulatory pressures and complexity, while smaller banks that are well managed can actually benefit from their agility. BCB Bancorp has been focused on disciplined lending and maintaining a strong balance sheet. That is critical, because in banking, survival and stability are everything. From a financial standpoint, the company has been generating consistent earnings and maintaining reasonable asset quality. It is not taking excessive risks to chase growth. Instead, it is focusing on steady, sustainable performance. And this is where the value opportunity comes in. Bank stocks, especially smaller ones, often trade at lower valuations during periods of uncertainty. Investors become cautious, sometimes overly cautious, but if the fundamentals remain intact, that creates an opportunity. 𝗣𝗟𝗡 Bancorp is one of those cases where the market may be underestimating the resilience of the business. Another factor to consider is income. Many regional banks offer attractive dividend yields, which can provide a steady return even if the stock price takes time to appreciate. That is something long-term investors should not ignore. Now I want to give you my honest take here. Banking is not without risk. Credit quality can deteriorate, economic slowdowns can impact loan demand, and interest rate changes can affect margins. But that is exactly why valuations tend to be lower. The key is identifying banks that are well managed and positioned to navigate those risks. 𝗣𝗟𝗡 Bancorp appears to be doing that, which makes it an interesting value play in the current market. And when you combine stable earnings, potential income, and a discounted valuation, you start to see why this stock deserves attention. The third stock is Sonos, ticker symbol SONO. Now this is a company that many people recognize immediately, but very few actually understand as an investment. Sonos operates in the premium audio space, designing and selling wireless speakers, home sound systems, and audio software that integrates seamlessly across devices. On the surface it might look like just another consumer electronics company, but when you dig deeper, you start to see that Sonos is actually building something much more powerful than just hardware. The real value of Sonos lies in its ecosystem. Once a customer buys into Sonos, they tend to stay. The products are designed to work together, to sync across rooms, and to deliver a consistent, high-quality audio experience. That creates a kind of lock-in effect, not in an aggressive way, but in a natural way where customers continue expanding their system over time, and that is where the moat starts to form. Because Sonos is not just selling speakers, it is building a connected audio platform that integrates with streaming services, voice assistants, and smart home technology. That positioning gives it long-term relevance as homes become more connected and entertainment becomes more personalized. Now let's talk about the current situation because this is where the opportunity is starting to emerge. Sonos has faced challenges. Demand for consumer electronics has been uneven, especially after the pandemic-driven surge. Supply chain issues and macroeconomic pressures have also impacted performance, and as a result, the stock has been under pressure. But this is exactly the kind of setup value investors look for: a strong brand, a loyal customer base, and a differentiated product offering that is temporarily out of favor. From a financial perspective, Sonos has been working through inventory adjustments and focusing on improving profitability. The company has also been investing in new product categories and software capabilities, which could open up additional revenue streams over time. One thing that stands out to me is how disciplined Sonos has been with its strategy. It is not trying to compete on price, it is competing on experience. And that is important, because premium positioning often leads to higher margins and stronger brand loyalty. Another key factor is intellectual property. Sonos has built a significant portfolio of patents around wireless audio technology that not only protects its products but also creates opportunities for licensing and partnerships. Now here is my personal take. Sonos is one of those companies that the market tends to misunderstand. When sales slow down, investors quickly assume the business is in decline, but in reality, what we are seeing could simply be a cycle. Consumer electronics demand is not linear. It moves in waves, and companies with strong brands and ecosystems tend to come out of those cycles even stronger. If Sonos can continue to innovate and expand its ecosystem, the long-term potential remains intact. And if the market is currently pricing in too much pessimism, that creates an opportunity. So when you look at Sonos today, you are not just looking at a speaker company, you are looking at a platform that sits at the center of how people experience audio in their homes. And that is a much bigger story. Now let's zoom out and connect everything we have discussed, because there is a common theme across all three of these companies. GigaCloud Technology is building infrastructure for global trade. 𝗣𝗟𝗡 Bancorp is embedded in local financial ecosystems. Sonos is creating a connected audio platform within the home. Three completely different industries, but the same underlying principle. Each company operates in a space where it provides essential value, not optional value. And that is what gives these businesses durability. Another thing they all share is that they are not the market's favorite stocks right now. They are not being driven by hype or speculation. In fact, you could argue they are being overlooked, and historically, that is where some of the best opportunities are found. Now, timing matters, especially when we are talking about a window like before April 3rd. Markets tend to reprice quickly when sentiment shifts, And when undervalued stocks start to gain attention, the move can happen faster than most people expect. That does not mean these stocks will explode overnight. That is not the point. The point is positioning yourself in businesses that have the potential to compound over time while being bought at valuations that give you a margin of safety. And that is the essence of value investing. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I want to ask you a question because this is where your perspective really matters. Which of these businesses do you think has the strongest long-term advantage? Is it GigaCloud with its global logistics and marketplace network, BCB Bancorp with its local banking relationships and stability, or Sonos with its premium ecosystem and brand loyalty? Let me know your thoughts in the comments, because I am genuinely curious to see how you are thinking about these opportunities. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.